Do you know why Public Bank and Hong Leong Bank stock prices can grow gradually in the long term, while Maybank has more fluctuation growth? Most of you might say because the fundamentals of these companies are better than the rest. But there is one important element that many investors left out of why the stock price can grow gradually in the long run. This important element you can find in the financial reports, and I'll share to you how to find it in this video. If you understand and know how to apply this important element into your analysis, you can sit back and watch your portfolio grow until you retire. There are many good fundamental stocks in the stock market, but not all of them will grow in the long run. Some are just a mid-term price hike, some not even provide enough shares to transact in the stock market. But why are some stocks suitable for long-term investment, some are not? If you look into these growing stocks, you will notice some similar characteristics in them. Most of them are in competitive sectors, where the margin of profits for the business are relatively small. The easiest way to be competitive in the market is to power up their supplies to lower the cost than the rest of their competitors. At the same time, they need a bigger market to sell their products. The best way to do this is to acquire other companies. Whether it is an upstream or a downstream, the acquisition will bring benefits to the business. Higher production, lower cost of production, capturing market shares, more assets shown on your paper, and many more. But the business world is different than we thought. Sometimes you can buy assets or business not using cash but shares. There's a saying in the financial world, if you own a listed company, it is like owning a money printing machine. It doesn't matter if the company is good or bad, you can print money out from the stock market easily. When your company gets listed in the stock market, you will not just receive public investor funds, your company shares are worth a value. You can use these shares in exchange for money, either through pledging shares for loans, issuing shares for private placements, issuing warrants for fundraising, and also acquiring companies in the form of share swap. In order for listed company owners to utilize their company shares for the above exercise, they will need to increase their company valuation, make their shares more sexy to financial institutions and to their competitors. To do so, you will need to jack their stock price up to show healthy growth in their company valuation. The first step is to attract institutional investors to invest into your company. This gives a good branding to other parties in the market. You can start telling people, look, BlackRock invested in my company or Warren Buffett invested in my company. It gives a huge confidence to the public and also financial institution. To attract them to invest in, you just need to have a decently good financial health that makes sure your company is growing. Their returns are always the stock price performance and whether it is possible for them to sell the share in the stock market. This is where the companies need to play the trick to make sure the stock price is moving up gradually. Once you get the brand ambassador in, your stock price will move higher because the demand created by the institutional funds and the other funds will follow, which will move the stock price higher again. All you have to do is to sustain the stock price in the bear market and give a little push for a recovery. With the share prices increasing with the demand of the institutional funds and other investors, you can start to use these shares to buy companies with share swap or pledge for other purchases like assets or as a guarantee. Acquisition like this will expand your revenue and also the valuation even faster for your business. Now you see why some stock prices are constantly growing in the long run. Because the company key person has a long-term view for the company and is not looking for short-term profit taken from the retail investors. We all know once you get listed, you are exposed for a hostile takeover by your competitors or some others who want a piece of cake from your company. Listed companies, key persons will use different ways to avoid losing their power while maintaining listed status. They can either flood the market with shares to make it difficult to acquire a majority of shareholdings. This method usually causes the stock price to be stagnant and very limited fluctuation. Or they hold majority of the shareholding while maintaining the required amount of floating shares in the market stated by the exchange. These type of stocks are not liquid to attract investors because the buy-sell spread in the stock market is huge and you will need to sell the shares at a very low price or wait forever for someone to buy. None of the above two options is good for retail investors because their intention is just to maintain public listed status and the stock price hardly grows higher. But the method we mentioned earlier in this video does give your company increasing value and also remain a power of control in your company if you do it right. Here's why. Remember, you are here because of the title Why Public Banks Can Stay Long-Term Growth in Their Stock Price. It is because they have to stay expensive to avoid losing the power to control the company. We all know that banks are always the business that everyone wants to be in. Increasing price per share can make it difficult to take over. It is because the price per share is expensive. When someone plans a hostile takeover, the share price has already gone up. So you need more funds to acquire the share. It makes it so expensive for acquirer to take over. So some of you might say, just buy the shares over the time and one day you will acquire the majority shareholdings, right? Yes, it is if the total units of share issue remain constant over the period. But we all know there's always bonus issue, new listed shares are issued and causing the total shares to increase every year. Together with the increasing stock price and share issue, you will need more funds to acquire the company. It creates a compounding effect on the cost that makes many acquirers give up on taking over that company. This is one of the marvelous things with this share management. You can also capture loyal investors, which they are helping you to limit the floating shares in the market and not willing to sell the shares to the acquirer privately, because you are getting bonus, dividends, and most importantly, capital gains from this investment. Unless someone offers you a price that is multiple times higher than the current market price, which is unlikely to happen because it is not worth to spend so much money for an entity. There is always other options in the business world. You can see how well they play the stock market game here, from managing a growing share value at the same time making your investor happy and doesn't lose the power to control in the company. These are good companies that we want to invest in, which they are not there to reap from the retail investors, giving returns to the investor while expanding their business. If you like more of this content about operational methods in the financial market, we have more to share with you. But I need your help to give us a like and share this out. So once we hit a certain amount of likes and shares, we will share the weird deals that the shark offer to the retail investor in the next video. So hope you enjoyed this video. I'll see you guys again. Round and Search. True traders react to the market.